Ever wondered what crypto would look like if it played by Wall Street's rules? What if Bitcoin had a boss like the SEC breathing down its neck from day one? We're diving into a parallel universe today. A world where Bitcoin isn't so wild and those crazy crypto stories might never have happened. Imagine a world with fewer Lambos and more index funds. Don't worry, we're not turning into financial advisors. We're here to explore the good, the bad, and the potentially hilarious consequences of a tamer cryptoverse. Picture this. Bitcoin debuts in 2009, but it's not the Wild West of finance. Instead, it's met with regulations and rules. Think of it like a rebellious teenager forced to wear a suit. Instead of shady ICOs promising the moon, we'd have carefully vetted offerings. Forget flash crashes and rug pulls, hello stability and investor protection. Would Bitcoin still have skyrocketed in value? Would early adopters have become millionaires? Or would it all be different? The excitement of the unknown would be gone, but would we have traded that for something potentially more valuable? Trust and stability. Fasten your seatbelts as we journey through a world where crypto acts more like a stock and less like a lottery ticket. We'll explore the impact on adoption, innovation, and even the culture of crypto itself. Would it have been a good thing, leading to greater stability and mainstream acceptance, or would it have stifled the very spirit of decentralization that made crypto so appealing in the first place? Would we have traded excitement for predictability? Get ready to explore the fascinating what-ifs of a regulated crypto universe. Let's rewind to the early days, back when Bitcoin was just a twinkle in Satoshi's digital eye. It was 2009, the financial world was reeling, and this mysterious new currency emerged. Bitcoin was the ultimate anti-establishment statement. No central banks, no government oversight, just pure, decentralized digital cash. It was the financial equivalent of a punk rock song, loud, rebellious, and a little dangerous. Back then, you could mine Bitcoin on your grandma's computer. It was the Wild West, a digital gold rush where anyone could potentially strike it rich. People were buying pizzas with Bitcoin, not knowing if it would be worth millions or become worthless overnight. The lack of regulation made it a playground for early adopters, tech enthusiasts, and, let's be honest, a few shady characters too. But it was exhilarating, a financial frontier where the rules were still being written. Part of crypto's early appeal was the sheer mystery of it all. Who was Satoshi Nakamoto? How did this blockchain thing actually work? Nobody really knew, and that was part of the fun. It was like stumbling into a secret society, a digital speakeasy where the drinks were strong and the conversations were even stronger. You had to be in the know, whispering about Bitcoin in online forums and trading tips with fellow cypherpunks. The lack of regulation added to the mystique. It felt like anything was possible, like the old days of the internet before big tech moved in. You could launch your own coin, build a decentralized exchange, or just ride the waves of volatility and hope for the best. It was a time of pure, unadulterated speculation. People were pouring their life savings into Bitcoin and altcoins, fueled by dreams of Lambos and early retirement. And hey, some of them actually made it. The early 2010s, a simpler time when Dogecoin was just a joke, and to the moon was a phrase uttered only by astronauts and overly optimistic crypto traders. Those were the days. Without regulations, the crypto space was a breeding ground for meme coins and bizarre projects. Remember that time someone created a cryptocurrency for dentists? Or the one backed by, wait for it, potatoes? It was a chaotic, hilarious, and sometimes downright scary free-for-all. Scams were rampant, rug pulls were a daily occurrence, and FOMO was the driving force behind most investment decisions. But amidst the absurdity, there was a sense of community, a shared belief that crypto could change the world. People were connecting online, sharing ideas and building the future of finance one meme coin at a time. But let's not paint too rosy a picture. The Wild West of crypto wasn't all sunshine and Lambos. Without regulations, the space was ripe for fraud, scams, and all sorts of shady behavior. Remember Mt. Gox, the infamous Bitcoin exchange that lost hundreds of thousands of Bitcoins? Or how about the countless ICOs that turned out to be elaborate Ponzi schemes, leaving investors high and dry? The lack of oversight meant that anyone could create a token, promise the moon, and disappear with people's money. It was the Wild West after all, and in the Wild West there are always outlaws looking to make a quick buck. For every legitimate project there were A dozen scams lurking in the shadows. It was a dangerous game, and many unsuspecting investors learned that the hard way. Despite the risks, the early days of crypto were also a time of incredible innovation. Without the constraints of regulations, developers were free to experiment, build and break things at an unprecedented pace. The Ethereum blockchain, with its smart contracts and decentralized applications, was born out of this era of experimentation. So were countless other projects, some successful, some not, but all pushing the boundaries of what was possible with this new technology. It was a classic case of high risk, high reward. The lack of regulation allowed for both groundbreaking innovation and rampant scams to flourish side by side. It was a wild ride, to say the least. The question is, would this same level of innovation have been possible in a more regulated environment? Would the pioneers of crypto have been able to push the boundaries so freely if they had to worry about compliance and regulatory hurdles? It's a question without an easy answer. So, would the crypto space have been better off if it had been regulated from the start? Would we have traded those wild price swings and meme coin madness for stability and mainstream acceptance? It's a tough call. On the one hand, regulation could have prevented a lot of the scams and fraud that plagued the early days. It could have given investors more confidence and paved the way for wider adoption. But on the other hand, regulation could have stifled innovation and discouraged risk-taking. Would Bitcoin have become just another asset class, stripped of its rebellious spirit and decentralized ethos? It's a hypothetical question, of course, but it's an interesting thought experiment. Would we have traded the excitement and volatility of the Wild West for a more predictable but potentially less innovative crypto landscape? All right, let's imagine a world where the SEC, the watchdog of Wall Street, decided to adopt crypto as its newest project. Instead of turning a blind eye to those early Bitcoin forums, they were all over it like a hawk, monitoring every transaction, every white paper, every single tweet about going to the moon. Remember those shady ICOs, where anyone with a dream and a website could launch their own token? Yeah, those would be gone. Instead, we'd have the SEC stepping in, demanding detailed prospectuses, audited financials, and maybe even background checks on the founders. Suddenly, launching a new cryptocurrency wouldn't be a free-for-all. It would be more like trying to get a traditional IPO on the stock market with lawyers, paperwork, and a whole lot of scrutiny. The Wild West just got a whole lot more civilized. But would it still be crypto? Imagine Bitcoin back in 2009 having to go through a traditional initial public offering or IPO. Instead of tech-savvy individuals mining Bitcoin in their basements, we'd have Wall Street investment banks underwriting the whole thing. We'd have roadshows, investor presentations, and maybe even Bitcoin commercials during the Super Bowl. The price of Bitcoin wouldn't be determined by anonymous traders on online exchanges. It would be set by market makers and institutional investors in fancy suits. The barrier to entry for both investors and creators would be significantly higher. Forget about throwing a couple of bucks into the latest meme coin. You'd need a brokerage account and a decent understanding of market mechanics. The whole crypto landscape would be transformed. But would this more professionalized version of crypto still have the same appeal? One of the biggest arguments for regulation is that it could have prevented those insane price swings we've seen in the crypto market. Remember when Bitcoin went from $60,000 to $20,000 in a matter of weeks? Yeah, that probably wouldn't have happened under the watchful eye of the SEC. They have tools to prevent such dramatic volatility, like trading halts, circuit breakers, and rules against market manipulation. We might have seen Bitcoin slowly climb the charts with a few bumps along the way, but nothing like the wild roller coaster ride it's been. For many investors, especially those new to the game, this stability would have been a good thing. It would have made crypto feel less like gambling and more like traditional investing. But for those thrill seekers drawn to crypto's volatility, it might have felt a little, well, boring. So, would we have traded excitement for stability? Would a more predictable Bitcoin have attracted the same level of interest and investment? Here's the thing about regulation. It often comes with a cost. While it can protect investors and stabilize markets, it can also stifle innovation and creativity. Would the same groundbreaking technologies like Ethereum's smart contracts or decentralized finance, DeFi, have emerged in a heavily regulated environment? It's hard to say for sure. On the one hand, regulation could have created a more cautious and risk-averse environment, making it harder for new, untested ideas to gain traction. Developers might have been hesitant to push the boundaries for fear of running afoul of regulations. On the other hand, some argue that regulation can actually foster innovation by providing clear guidelines and a level playing field. Knowing the rules of the game can encourage more institutional investment and attract talented individuals who might have been hesitant to enter the Wild West of unregulated crypto. So, would regulation have been a net positive or negative for innovation in the crypto space? It's a complex question with no easy answers. Perhaps the most significant impact of regulation would have been on crypto's image. Without those stories of scams, hacks, and wild price swings, crypto might have shed its image as a shady, risky investment and gained mainstream acceptance much earlier. Imagine seeing Bitcoin advertised alongside mutual funds and ETFs, endorsed by financial advisors and discussed on mainstream news channels without a hint of skepticism or fear. It's a world where your grandma might actually ask you about your crypto portfolio at the dinner table. But would this mainstream acceptance have come at a cost? Would crypto have lost its rebellious anti-establishment edge? Would it just become another tool for the wealthy to grow their wealth, leaving behind the original vision of a decentralized, democratized financial system? It's the classic dilemma of progress versus principles. Picture this: Bitcoin, but with a regulatory chaperone. Instead of lurking in the shadows of the internet, it's suddenly thrust into the spotlight, rubbing shoulders with traditional finance folks. Talk about an awkward family reunion. On one hand, regulation could have bridged the gap between Wall Street and Crypto Street. Imagine a world where financial advisors, instead of scoffing at Bitcoin, actually recommend it to their clients alongside those boring old index funds. But let's be real, part of crypto's appeal was its outsider status, its stick-it-to-the-man attitude. Would that rebellious spirit have survived if Bitcoin had to play by the establishment's rules from day one? It's like that indie band you loved that suddenly goes mainstream. Sure, more people know their music, but something feels different. Would regulation have sanitized crypto, stripping it of its unique decentralized vibe? Let's face it, the average person finds crypto about as approachable as quantum physics. It's confusing, volatile, and let's not forget all those horror stories about scams and hacks. Regulation, however, could have changed that perception entirely. Imagine a world where buying Bitcoin is as easy as ordering a pizza on your phone. You open your government-approved crypto brokerage account, click a few buttons, and bam, you're a Bitcoin holder. With the SEC's stamp of approval, crypto wouldn't feel like a gamble. It would feel as safe and familiar as online banking. Suddenly, everyone from your neighbor to your grandma would be asking, "So how much Bitcoin do you own?" Faster adoption means greater awareness, more investment, and potentially a much quicker path to becoming a mainstream currency. But would this widespread acceptance have come at the cost of crypto's original vision of a decentralized, peer-to-peer financial system? Remember when institutional investors were hesitant to even utter the word Bitcoin? Well, in a regulated crypto universe, things could have been very different. Imagine BlackRock, Fidelity, and those massive pension funds pouring trillions into Bitcoin and Ethereum. Regulation would have given these institutional giants the comfort and security they crave. No more worrying about regulatory uncertainty or shady exchanges. It would have been a green light for Wall Street to dive headfirst into the crypto pool. This influx of capital could have sent crypto prices soaring to unimaginable heights. We might be talking about Bitcoin being worth millions, not just thousands. But with great power comes great responsibility, or in this case, potential control. Would these institutional behemoths have become the new gatekeepers of crypto, influencing its direction and potentially stifling innovation? Would crypto have become just another tool for the already wealthy to consolidate their wealth? One of the most exciting developments in the crypto world has been the rise of decentralized finance, or DeFi. From lending and borrowing platforms to decentralized exchanges, DeFi promised a financial system free from intermediaries and traditional gatekeepers. But would this revolution have been possible in a regulated crypto landscape? Regulation, by its very nature, involves rules, oversight, and often centralization. Would DeFi have been able to flourish under the watchful eye of regulators? It's a double-edged sword. On the one hand, regulation could have stifled the creativity and experimentation that fueled DeFi's growth. Developers might have been hesitant to launch new projects for fear of regulatory backlash. On the other hand, some argue that regulation could have actually benefited DeFi by providing clear guidelines, increasing trust, and attracting more mainstream users and investors. It's a classic debate with no easy answers. So, would regulation have been net positive or negative for the soul of crypto? Would it have killed the excitement, the volatility, the Wild West energy that drew so many to this space in the first place? Or would it have paved the way for wider adoption, greater stability, and a more mature and responsible crypto ecosystem? Would we have traded those to the moon dreams for something potentially more sustainable and impactful in the long run? It's the ultimate question, and there's no single right answer. Regulation could have brought both benefits and drawbacks. It might have tamed crypto's wild side, but it also could have unleashed its true potential to revolutionize finance and beyond. The thrill of the crypto casino, volatility junkies rejoice. Let's be honest. Part of crypto's allure was the adrenaline rush of those wild price swings. It was like playing a high-stakes poker game where your portfolio could double overnight or vanish just as quickly. Regulation, however, would have sucked the fun out of that casino-like atmosphere. Remember those days when Bitcoin would jump 20% on a single Elon Musk tweet? Those days would be long gone in a regulated crypto market. The SEC doesn't take kindly to market manipulation, even if it's just a billionaire with a Twitter addiction. Those heart-stopping dips, the frantic buying and selling, the constant fear of missing out, FOMO, all those things that made crypto so exciting and, let's face it, a little bit addictive, would have been replaced by, well, something a lot less thrilling. Instead of a wild roller coaster ride, Bitcoin might have felt more like a leisurely gondola ride through the canals of Venice, scenic, predictable, and maybe a little too tranquil. Taming the wild price swings, a smoother ride for your portfolio. For every crypto enthusiast who thrives on volatility, there's another who's lost sleep, hair, and maybe even a few years of their life watching their portfolio swing wildly. Regulation, with its emphasis on stability and investor protection, could have been a godsend for these folks. Imagine a world where Bitcoin's price movements are measured in percentage points, not double-digit swings. Instead of those gut-wrenching crashes, we'd have orderly corrections, managed declines, and maybe even the occasional dead cat bounce, but nothing too dramatic. For long-term investors, this stability would have been a welcome change. They could finally invest in crypto without worrying about their life savings disappearing overnight. Retirement planning with Bitcoin? Sure, why not? But let's be real, a little bit of risk is what makes investing exciting. Would those early adopters have poured their hard-earned cash into Bitcoin if it had the same volatility as a government bond? Would the crypto market have attracted the same level of innovation and investment without that element of risk? The end of To the Moon? A world without Lambo memes? In a regulated crypto universe, the iconic To the Moon meme might never have seen the light of day. Those dreams of buying a Lamborghini with your Bitcoin profits? Yeah, probably not going to happen when the SEC is watching every transaction. The crypto culture we know today, with its memes, its jargon, its unique blend of tech enthusiasts and get-rich-quick dreamers, would have been very different. It's hard to imagine a world where HODL is a legitimate investment strategy endorsed by financial advisors. Instead of Lambos and moon landings, we might be talking about diversification, risk management, and the importance of a balanced portfolio. It's a world where your crypto gains are measured in percentage points, not Lambos per Bitcoin. Would this more mature and responsible crypto culture have been a good thing? Or would it have sucked the fun out of the space, turning it into just another boring asset class for the financially conservative? Section 4, institutional investors, they like their charts predictable. Let's face it, institutional investors, those behemoths of the financial world, aren't exactly known for their love of risk. They like their investments predictable, stable, and preferably with a long history of steady growth. Regulation could have given them exactly what they wanted in the crypto market. Imagine a world where BlackRock and Fidelity are scooping up Bitcoin like it's going out of style. They'd be creating Bitcoin ETFs, Bitcoin index funds, and maybe even Bitcoin-backed retirement accounts. Your grandma's pension fund might even have a little bit of Bitcoin in it. This influx of institutional capital could have been a game changer for crypto, bringing in trillions of dollars and legitimizing it in the eyes of traditional finance. But it also could have come at a cost. Would these institutional giants have used their influence to reshape the crypto market in their own image, prioritizing stability and predictability over innovation and decentralization? Would they have become the new gatekeepers of crypto, controlling its destiny and potentially stifling its disruptive potential? Section 5, From Heart Attacks to Heart Health, the Emotional Toll of Regulation. Let's not forget about the emotional roller coaster that is crypto investing. Those wild price swings, those overnight fortunes made and lost, all that FOMO and uncertainty. It takes a toll on a person's mental well-being. In a regulated crypto market, our collective blood pressure might have been a few points lower. We'd be sleeping better at night, knowing that our crypto investments are safe and sound, tucked away in our SEC-approved brokerage accounts. No more panic selling, no more FOMO-driven buying sprees, just calm, rational investing based on sound financial principles. Our therapists would thank us for it. But would we have become too complacent? Would we have lost that sense of excitement, that thrill of the unknown that made crypto so captivating? Would we have traded our emotional well-being for a more boring, predictable, but ultimately less exhilarating crypto experience? Section 1. Wall Street's cautious dance with crypto. Remember those early days when Wall Street wouldn't touch Bitcoin with a 10-foot pole? They called it a bubble, a scam, a plaything for tech geeks and anarchists. Institutional investors, those masters of the universe with their trillions of dollars, were perfectly content watching the crypto show from a safe distance. They were used to the familiar rules of traditional finance, stocks, bonds, commodities, things they could analyze, predict, and control. Crypto, with its decentralized nature and wild price swings, was just too unpredictable, too risky for their taste. But even Wall Street couldn't ignore crypto forever. As Bitcoin's price climbed higher and higher, as blockchain technology gained mainstream attention, those whispers of skepticism turned into murmurs of curiosity, then into full-blown FOMO. The problem was, the lack of regulation was a major roadblock. Institutional investors need rules. They need certainty. They need to know that their investments are protected. Without those safeguards, crypto remained a no-go zone for the big players. Now imagine a parallel universe where crypto had been regulated like the stock market from day one. What if, instead of turning a blind eye, the SEC had stepped in early on, setting clear guidelines for trading, listing, and investor protection? In this alternate reality, institutional investors wouldn't have hesitated to jump into the crypto pool. They would have seen it as a new asset class, a new opportunity to diversify their portfolios and potentially reap massive rewards. We're talking about trillions of dollars flooding into the crypto market, pension funds, hedge funds, endowment funds, you name it. Bitcoin wouldn't just be a digital currency anymore, it would be a mainstream investment, traded alongside Apple stock and government bonds. The impact on crypto's price would have been astronomical. Imagine Bitcoin not just hitting $60,000, but soaring past $100,000, $500,000, maybe even reaching that mythical 1 million mark. It's enough to make your head spin. The influx of institutional money wouldn't just have impacted crypto's price, it would have transformed the entire industry. Wall Street, with its vast resources and influence, wouldn't have been content just buying and selling crypto. They would have wanted to shape the market in their own image. We're talking about the creation of sophisticated crypto trading platforms tailored specifically for institutional investors. We're talking about Bitcoin ETFs, Bitcoin index funds, Bitcoin-backed retirement accounts, you name it. Wall Street would have found a way to package and sell it. The media narrative around crypto would have shifted dramatically as well. Instead of focusing on scams, hacks, and volatility, financial news outlets would be praising crypto's potential for growth, its role as a hedge against inflation, and its ability to revolutionize the financial system. Those same Wall Street analysts who once dismissed Bitcoin as a fad would be falling over themselves to issue bullish price predictions and tout its virtues to their clients. It would be the ultimate validation for the crypto industry, but would it come at a cost? Section 4. The price of institutional love, innovation versus control. While institutional investment would have undoubtedly brought legitimacy and stability to the crypto market, it also could have come with some unintended consequences. One of the biggest concerns is that it could have stifled innovation and centralized control. Wall Street, with its focus on profits and risk aversion, might not have been as receptive to the kind of experimentation and creativity that characterized the early days of crypto. Would DeFi, NFTs, and other groundbreaking innovations have flourished in a market dominated by institutional investors? Moreover, the influx of institutional money could have given a handful of large players disproportionate influence over the crypto market. They could have used their financial clout to shape regulations in their favor, potentially stifling competition and limiting the decentralized nature of crypto. In essence, crypto could have become tamed, losing its rebellious spirit and becoming just another asset class for the wealthy to profit from. It's the classic dilemma of progress versus principles. Would crypto have been better off staying true to its roots, even if it meant remaining on the fringes of finance? Or would mainstream acceptance, even at the cost of some of its soul, have ultimately been a good thing? So there you have it, a glimpse into a world where crypto played by Wall Street's rules from day one. Would it have been a utopia of stability and mainstream adoption? Or would we have traded the soul of crypto for a more predictable, but perhaps less exciting financial landscape? The truth is, there's no way to know for sure. Crypto, in its very essence, is about challenging the status quo, disrupting traditional systems, and embracing the unknown. Trying to predict its path with absolute certainty is like trying to herd cats, entertaining but ultimately futile. What we do know is that regulation, while often portrayed as the antithesis of crypto's decentralized ethos, is not inherently a bad thing. It can bring much-needed stability, investor protection, and mainstream acceptance. All crucial ingredients for any technology aiming to revolutionize the financial system. The key, as with most things in life, is balance. Finding that sweet spot between fostering innovation and protecting investors, between encouraging responsible growth and preserving the decentralized spirit that makes crypto so unique. It's tempting to look back at the Wild West days of crypto with a mix of nostalgia and relief. Nostalgia for those early days of experimentation, community, and the thrill of the unknown. Relief that we survived the scams, the hacks, and the wild price swings, but it's important to remember that crypto is still in its infancy. It's like the internet in the early 90s, full of potential, but also uncertainty. We're still figuring out what crypto is, what it can be, and how it will reshape our world. Regulation, rather than stifling innovation, could actually be the catalyst that propels crypto into the mainstream. It could be the bridge that connects the world of traditional finance with the decentralized future that crypto promises. Imagine a world where crypto is no longer seen as a fringe technology, but as an integral part of our daily lives. A world where we use stablecoins to buy coffee, where our retirement savings are partially invested in blockchain-based assets, where we can send money across borders instantly and securely without relying on banks. The future of crypto is not a binary choice between a completely unregulated Wild West and a heavily regulated Wall Street-dominated market. The reality, as always, is likely to be somewhere in between. The challenge and the opportunity is to create a regulatory framework that fosters innovation while protecting investors, that encourages responsible growth without stifling the decentralized spirit that makes crypto so compelling. This will require collaboration, not confrontation, between regulators, innovators, and the crypto community as a whole. It will require a willingness to compromise, to adapt, and to embrace the unpredictable nature of this transformative technology. So buckle up, because the crypto roller coaster is far from over. The next chapter promises to be just as exciting, just as unpredictable, and potentially even more impactful than the last. The question is, will we be ready to ride the wave, or will we let fear and uncertainty hold us back? The future of finance, in many ways, depends on the answer. This was it for today. Let me know what you think. Drop your thoughts in the comments below, and don't forget to like and subscribe for more business conspiracies. Until next time, keep questioning the status quo.